a little above 3% in the next couple of years. For more on how these global interest rate hikes are affecting our world, Ted Rossman, a senior industry analyst at bankrate.com and creditcards.com, joins us. Good to see you again, Ted. I think the last time we talked, I think we had been expecting these interest rate hikes. So now we got it from the BOE, we got it from the Fed, and you heard what we just said about Australia. Are we kind of on track, and is it time to dial back our expectations?
At least according to Jerome Powell's comments yesterday, not yet. It seems like the Fed is going to continue to push on these interest rate hikes for the foreseeable future. Now, maybe the pace slows a little bit. Markets are pricing in roughly a 50-50 chance next month, whether that's 50 basis points or 75. But I think that the real mandate that we heard yesterday from Powell was higher for longer. So this Fed funds rate may top out at 5 percentage points, and that's still a point and a quarter higher than it is now, and it may stay there for much of next year. So I think that's an important consideration for the economy and for consumers.
Is this working? Are we bringing, I mean, what the UK is doing, what Europe is doing, and all the countries, we're sort of in unison in trying to fight inflation, right? So, and no one's been able to answer this question, but is it working to beat inflation?
That's really the central question here. This monetary policy does take a long time to filter through to the economy. So they often talk about these long and variable lags. Maybe it's 9 months, maybe it's 12 months. We're only about 8 months into this hike cycle. And the Fed didn't really get serious until the summer. So it's really only been about 5 months since the sizable hike started to kick in. So I think we still have a ways to go. One area that we're definitely seeing immediate impacts is the housing market. We've seen the 30-year fixed rate mortgage go from 3.25% at the end of last year to over 7% now, the highest in 20 years. Couple that with already high home prices. I mean, especially new buyers are really getting squeezed on the affordability front. So the Fed has already really dampened demand in the housing sector. Outside of that, though, we really haven't seen demonstrable effects on other aspects of the economy.
What about regular people like you and I? We've got credit cards, we go out and we buy coffee, we buy food, and we're just going about our normal day. How does it impact the regular person? And I get we pay a little more for gas and a little more for this, but is our lifestyle going to change? Are we changing the way we live?
There's a lot of interesting stuff going on here. On one hand, we have the fact that inflation is bad for everybody. So the Fed needs to be fighting that. Nobody wants to be paying so much more for gas and food and housing. But the medicine can be bitter because you're right, your credit card rate is up. Credit cards right now are charging 18.77% on average. That's the highest in 30 years. We're soon going to zoom past 19% for the first time on record. Our database goes back to 1985. So sizable added costs for people with credit card debt. You know, we've talked about the impacts on the housing market. We haven't yet seen a slowdown in the labor market, but it does feel inevitable that at least a mild recession is probably on the horizon. The question is, does unemployment go from 3.5 to 4.5 or 5, which wouldn't be so bad broadly speaking, or does it go higher than that? You know, I think the Fed is still waiting for evidence that this slowdown is happening, but they don't want to hit the brakes so hard that they tip us into a sharper recession. So it's a tough job here that they have.
I saw a stat the other day that said that wages for workers like you and I are up, I think 7.7% or something like that on average. And I also saw a stat that we have the most number of jobs apparently available in a very long time. So we still have a shortage of workers. Pay is still going up, which means that employers will have to pay more money, which means they'll probably keep raising prices. Now, I understand the lag, right? It takes time for all of us to go in. How much time do we have to wait until we see the impact of these higher rates? Is it Q1, Q2, Q3, Q4? I mean, is it going to happen in our near-term projections?
I think in theory, we should be seeing the impacts by the spring, maybe like the end of the first quarter, early second quarter. I'm kind of basing that on 9 months from June, which is when the Fed started with these larger hikes. But we know things don't always play out exactly in the real world as they might in a more theoretical sense. You're right about the heat in the job market. I think that's been surprising a lot of people, probably the Fed among them, just because there are still almost 2 available jobs for every one person looking for work. We
Very,
are
very
worried about
quickly,
that weak
I
price
only got
environment.
30 seconds left, but I want to talk about inflation outside of the U.S. as well, because you look at China, you look at Asia, they don't have the inflationary problems that we're talking about here. Why is that?
Yeah, I think right now China's inflation rate is kind of the envy of the world, under 3%. I mean, that's where the Fed would like to take it. Unfortunately, in China, there's other challenges with slower economic growth, COVID lockdowns. I think that's one thing that's probably keeping a lid on inflation.
Ted, always good to have you. Thank you very much. Next up on
Thank
our show, Russia.